So section 3.2, we're going to talk about loans today. We're doing a lot of talk in the last chapter about the opposite of loans, which would be savings or deposit accounts. And a lot of the things we learned regarding those accounts are just the opposite now, because with deposit accounts like savings and CDs and checking, you're giving the bank money, in other words, loaning the bank money for them to use, and that money that people loan them with their savings and checkings and certificates of deposits and money market funds and whatnot, they use that money to then make loans to you and other people. A slightly different interest rate, of course, right? So we have some terms in here we need to talk about. I would say the very first one is anytime you take out a loan, by law, the bank is required to provide you with what's called a Truth in Lending Act disclosure, or a TIL, T-I-L. That's the Truth in Lending Act. Okay. So what that does is that allows you to get all the information, every detail about your loan, from the interest rate to the finance charge to the total interest paid over the loan, the payment, all the terms, all the details. And so that way you can then compare that information directly with offers from other banks. So here's the definition of truth in lending, kind of a brief one. It protects you against inaccurate and unfair credit billing. Okay? Protects against inaccurate and unfair credit billing. So in other words, there will be no surprises in credit card practices. Okay, so they're required to provide you with loan cost information and all the details of the loan. Okay, so they must provide all details about loan cost, in other words, the interest paid, terms, finance charge, etc. And again, the idea is that there can be no surprises. Nothing that you didn't anticipate or expect. And I'm going to include in the notes here so that you have a sample truth in lending statement. Show the next page here. So this is the type of document. And they vary slightly from bank to bank, but not too much. They really are supposed to look pretty much the same, everything the same location, but they will definitely vary depending on the loan type that you get, whether you get just an unsecured loan or a credit card loan versus an automobile loan or a mortgage. This one happens to be the truth in lending disclosure for a mortgage, so it's going to be quite a bit more complicated. But what will be the same is the very start here. Notice that these details are spelled out. The annual percentage rate of your borrowing for this particular mortgage, 6.88%. Okay, and that rate is the one that's annualized, like simple interest, so you can directly compare. We call that APY with a deposit account. Now the dollar or the finance charge, right? This is the dollar amount it will cost you. That's all the interest that you'll pay over the life of the loan. Okay, in this case, $129,000. That's just in the interest. Okay. Now the amount they're borrowing is also listed here, $186,147, and then the total of what you borrowed right here plus the interest finance charge over the life of the loan gets added up, and this is the total that you pay back. So, and if you take a look at these numbers, again, this is a mortgage, and it might be going out for, let's see, oh, this is a balloon payment one, so slightly different. We'll get into balloon payment stuff later. Looks like we have 120 payments, 120 monthly payments, right? So that would be a 10-year loan, okay? You can go 10, 15, 20, 25, or usually up to 30 years for your mortgage if you like. So here's the monthly payment that you would make each month. That detail is there. And then they have this, I'll explain this balloon payment. I don't really like those, and when I worked at the bank, we really didn't like to issue balloon mortgages. It's where there's one. So the regular monthly payment is lower than it normally would be, but then the trade-off is your very last payment at the end of the mortgage term is enormous. That's the balloon, okay? Not the best idea usually, okay? And this tells when the payments are due, right? And what date. And they have some other things here. They also include, because with a mortgage, you're generally going to have some insurance that you have to purchase, right? And there's the cost of the insurance for the 10 years of the mortgage, okay? So there's a lot of costs involved with a mortgage. So this gets a lot more complicated than just a regular, personal loan or something like that, because they have to have the house as collateral. It has to go through the court system. Lawyers have to do title searches, right, to make sure there are no other liens on your house. Because if there's another lien, in other words, another bank has a mortgage where they have your house as collateral, this bank, might not want to lend you the money, because then, well, what's their collateral, right? On the next page, now this is what you won't see on a regular truth in lending. That's a simple one because this is complicated. Here are some mortgage costs. We have this loan origination fee, $1,900. Tax administrative fee is $650. Doc prep fee, they have to pay somebody to do all the documents, right? The documents for a mortgage are as thick as a book, really. It is quite a procedure, right? Closing fees over here. Abstract or title search, that's where they're looking to make sure that they'll be the only ones holding your property as collateral in case you default. Another doc prep fee. You need a notary involved. You need attorneys involved, okay? Somebody to bind up the title, right? Or in New York State, it's called an abstract. And you can see all these other costs. I'm not going to go through all these, but you can see every single detail is spelled out, okay? Even breaking down the components of the monthly payment, right? The principal and interest is $1,049, and they had done what's called escrowing in the taxes. So instead of you separately paying your taxes each year to the village or the town or whatnot, you can pay the bank a little bit of an extra payment monthly, and they will use that money to pay your taxes, and also hazard insurance. Right? You need to have insurance on the home, because the bank needs to take your home, but it's been destroyed by a tornado. They've got nothing. Okay? And there's some other, yeah. So that's a pretty complicated version of this. So that's in the notes here online, which you don't have with you right now, but you have access to them. Cool. There's some other terms on page 157 that you really ought to be familiar with. I'll just go down the list here. They refer to a cosigner. Right, so a cosigner is useful, well, for people your age, 18-year-olds that don't really have any credit built up, and it would be difficult for a bank to loan them money not knowing, what kind of history they have, because they don't have a history. So maybe your parents or a nice uncle will cosign a loan for you, and they'll look at his or her credit, right, and compare it with yours, and they give you the loan. But the problem is, the cosigner, somebody might be hesitant to do it, to cosign for you, because if you default on that loan, then whoever cosigned is on the hook for it. It gets, like, if you make a late payment, then that shows up on your cosigner's credit report and starts taking their credit score down. And a lot of people don't want to do that. Okay? Sometimes you're required to have life insurance, not for regular loans usually, but for a mortgage definitely. Okay? Well, not definitely, often. Because we talked about it in class the other day. Somebody asked, what happens if you die before you pay off? Well, your life insurance will pay the bank back what you owe them. Prepayment privilege, just discuss that real quick. If you get a chance, some people like to pay off their loan early before it's due. Let's say you took out a 5-year loan for a car. Maybe you have the opportunity to completely pay the bank off that loan in 1 year, right? Well, how does that help you? That helps you because you're not paying nearly as much interest as you would had you gone out the full 5 years. But that also means the bank is not getting as much interest from the loan they gave you. They weren't getting what they expected. Now, some banks and some loans will have what's called a prepayment penalty, whereby if you do pay off the loan early, there is a fee that they charge you. It's a good solid chunk of a fee, right? Because they want to kind of discourage that. That's not very common these days because as banks and credit unions start to get more and more competitive, I have not seen anybody with that has a prepayment penalty. Most of the time, and I would say every loan that I've ever had in my lifetime did not have a penalty for prepayment. So if I wanted to, I could pay it off early without penalty. And then on the next page, on page 158, they talk about wage assignment. That's a voluntary deduction, okay? Wage assignment, or I might say, we call it auto debit, where you have a certain monthly payment and you agree to let the bank just take that payment automatically each month out of your checking account. And that way, they're a little more sure that they will get the payment each month because they don't, there's no risk of you forgetting to send it in. And so a lot of times they'll offer a slightly lower rate if you do the auto debit or wage assignment route. And another thing they do is for car loans, oftentimes they'll do what's called a bi-weekly auto debit. So they take the monthly payment, split it into two, and you pay that every 2 weeks. It's half that payment every 2 weeks. And that helps you save a little bit of interest charge because sometimes there's more than 2 payments in a month, right? Because a month isn't exactly 28 days. So you end up paying your loan off a little bit earlier, okay? And the interest doesn't accrue as much with that. Wage garnishment, yeah, that's, if you default, that would have to be in the agreement of the loan. That's not a very common thing. If it gets down to wage garnishment, they've gone through the courts to get a judge to determine that, and that's just usually too big of a hassle for a bank. And on the top of page one, the last one is the balloon payment. That's the one I just showed you with that mortgage. Again, that's where if you regularly had a monthly payment of $2,000 a month, so I can't afford that right now. So bank says, okay, let's make it $1,500 a month, but your very last payment is going to be pretty sizable. It'll balloon up for that last payment. Not recommended for most people, right? And I think the idea is that you're anticipating, I can't afford a big payment right now, but later on I may be able to. So a balloon payment might be useful for somebody maybe starting a small business, right? And when you first start a business, your revenues start kind of come in slowly, right? But you obviously anticipate revenues to increase as the years go on, right? So later on, you can afford a bigger payment. But otherwise, a balloon payment's kind of risky because you don't know at the end of that term whether you can make that giant payment or not. Okay, and I would also ask you to be very familiar with the terms down the middle of page 158, the different types of lenders, banks, credit unions, pawn shops, and payday loan stores. We kind of touched on some of those the other day. But down at the bottom there, some of these terms aren't highlighted. One very important one is the Equal Credit Opportunity Act. Equal Credit Opportunity Act. And this is a law that says a lender must treat everyone fairly regarding a loan. They can't discriminate or anything like that. So you must be treated fairly, generally. And if you are turned down or denied a loan, they are required by law to tell you exactly why, okay? So they must disclose reasons for turn downs. Or denials, right? Whether it be something in your credit report that they didn't like, or that you don't make enough income for the monthly payments, etc. They can't just say no and not tell you why. By law, they have to tell you why. And then the other thing at the bottom of page 158 is the Fair Credit Reporting Act. Fair Credit Reporting Act. The Fair Credit Reporting Act says that your credit history must be reported accurately. Not often, but every now and then there could be an error on your credit report as they go to the credit bureaus. And if that happens, you have the right to contest or dispute, some poor credit, maybe they say you had a late payment and you did not have a late payment. Errors can happen, right? Or someone else's. Another story is that my father has the same first name, and years ago there was something on my credit report that he had been, a late month or two on a payment, but our names were close enough that it went on to my credit report for some reason, and I had to dispute that. And after a little while, I successfully managed to get that taken off. Okay. So, accurate credit report. Gives you the right to dispute things. That you think are in error. All right, so be familiar with those terms. Let's move on to some examples where we'll do some calculations. So over on page 159, we're going to skip example 1 because they use this table of estimated loan payments. And this kind of table has not been used in decades because, we have computers now. I did have to use these years ago before computers were prevalent, but not anymore. So we're going to pass on example 1. And example 2 is kind of based on that same table, but we're going to go ahead and use either the monthly payment formula or the time value of money solver on our calculator. So let's go to example 2, 159. Example 2 says, what's the total amount of the monthly payments for a 4,000 two-year loan, APR 4%, according to the table? Well, we're not going to use the table. We're going to use our TVM solver on the calculator, okay? And we're going to have an N, okay? So that's going to be 2 years, right? Compounded monthly, right? So it's going to be 2 times 12 months, right? And then we're going to have the I as a percent field. Now remember, we have to take the annual rate divided by 12, right? So it's going to be 4% divided by 12. And the present value, that's going to be positive 4,000 because it's money coming to you, right? You're borrowing it, okay? And then when you get down to payment, right, that's where you will enter all this other information, go down to the payment field and hit enter, and you should get negative 173.70 per month. Okay, so that's the amount of payments. Okay, So to get the total of all the payments, we take that monthly payment, right? So our total of payments, okay, that's going to be the 173.70, and it's 2 years paid every month, so it's 2 times 12, so it's 24 payments of this amount, and you'll be paying a total back of $41.68.80. Okay. We've kind of done a little bit of this here, especially when it came to savings account and putting in monthly deposits. Okay. So you could probably think now, well, maybe I could figure out the actual total finance charge, right? If we know the total of all the payments is $41.68.80, and we borrowed $4,000, how much should we pay at the end of the month or at the end of the term? Okay. But before we go on to example 3, which is going to ask us to do just that, I want you guys to look at the check for example 2 using your TI TVM and figure out what the total of all the payments is of that one. So take a moment, pause the video, see if you can work through that. So it's a 4-year loan, compounded monthly. So this will be 4 times 12 in this field. Annual rate is 3%. So that's 3 divided by 12. And we're borrowing $5,300. So the present value is $5,300. And then we go down to payment. If you did this right, it should display negative $117.31. Okay. So that's each payment. So now we get the total by multiplying that times 4 times 12, 4 years times 12 payments is 48, and a total payment back of $56.30.88. All right, so let's move on to example 3, which is really, they weren't real clear about it, but it is based on, I think it's based on example 2. Okay? So anyway, if it's not, we're just going to use example 2's. So 41, yeah, it sure is. Okay. So example 3 over on page 160 is based on example 2. In example 2, we found the total of all the payments. Example 3, they're asking us to find the finance charge. Well, it's pretty simple. This is just parenthesized from example 2. All right, so in example 2, all the payments added up to $41.68.80 minus the amount we borrowed, which was $4,000, which gives us a total finance charge of $168.80. All right. So really, you can think of that as the convenience for getting the $4,000 now instead of later, like instead of having to save up for it. And of course, you'll just have to decide whether it's worth it to you or not. Well, that was simple enough. Now, before we go on to example 4, let's see. Let's do a review of some of the formulas that we've used. Oops. Let me go back here. Page, I think. There we go. So as a quick review, come on now. IEW, and we're acting up again. We have a simple interest formula, you recall? Interest. Brief. All right, that's the I equals principal times rate times time. All right, And then our compound interest formula. That was our future balance is principal times 1 plus rate over n to the nt. Okay. And then for continuous compounding, it's like an infinite number of compounding periods. Get this fixed, I guess. That was our balance equals P E to the RT. Okay. So we introduce a new formula here in example 4. I'm just going to go ahead and give it to you. And it's based on some of these here, but it's a formula to calculate the monthly payment. And yeah, it's kind of a mess. So monthly payment formula. And it's what we had been using the TBM solver for just now, but you know, it's financial algebra, so I do want you to be able to demonstrate you can plug in and use this formula correctly. And here's this mess. So M for monthly payment equals principal times rate over 12, right, because it's monthly, okay, times 1 plus rate over 12 to the 12t, and this whole thing over 1 plus rate over 12 to the 12t minus 1. Yep, and that's kind of a mess, I know. But you should be able to work through that. And after you've demonstrated that, then, you know, I'm fine with using the TBM solver. Well, let's go to example 4 now that we have that payment in the bag. We could use the TBM. We're going to do it the hard way. Okay? So example 4 on page 160. Brother, this thing just is really pushing out on me. Example 4, so Mark bought a new car. Total amount he needs to borrow is $28,716. He wants to take a 4-year loan, rate of 3.112. What's the monthly payment? Well, we could use a TBM, but you know, let's be big kids here. So our monthly payment for this thing is going to be our principal, $28,716. Okay. Times our rate. Be 0.0312 over 12 and 1 plus 0.0312 over 12 to the 12, and our T, your time is 4 years. Okay, and this whole thing over 1 plus 0.0312 over 12 to the 12 times 4. I'm going to tack on the minus 1 over here. So again, we're going to want to be very careful grouping things in our calculator. So let's try and do this without messing anything up. Okay, so I'm going to need parentheses. We're going to have 28,716. Another set of parentheses, 0.0312 divided by 12. Outside of those, more parentheses, 1 plus 0.0312 divided by 12. There, go to the exponent to the 12 times 4. Right. Outside of those now, divided by another set of parentheses. Got to group that. We need to nest it. 1 plus 0.0312 0.0312 divided by 12. Those. Oh, whoops, I should have gone here. And then exponent, 12 times 4. Move down and tack on our -1. I think that's got it. Double check. It looks like we get it all grouped right. I do anyway. So your payment would be $637.13 according to that formula. Equals $637.13. Kind of a messy way to do it. And if you wanted to go back and double check yourself with the TBM, that would be fine. Okay. So I'll ask you to take a moment, go down just below example 4 is the check for it. Use the monthly payment formula to answer this. Okay. Make sure you can accurately put that in your calculator. So pause the video for a moment, and I'll be back in a second. Well, while I was paused there, I went ahead and plugged everything in to the formula for the check there. And if you did this correctly, you should have gotten a payment, monthly payment of $84.47. If you didn't get that, you might want to go back and check what you plugged in, check how you put it in the calculator, etc. Okay. All right, our last example is, well, it's an example of a loan from it's like a payday store. These situations are ill-advised, and you'll see why when we get through this, because the interest rates are pretty staggering. So I guess she's going to need to borrow $400 till the next paycheck, which I guess comes in 3 weeks. So she goes to Friendly Fred. He loans her $400 for 3 weeks. Okay, so keep that in mind. It's $400 for 3 weeks. And she pays it back in full. So that's kind of like a time note, I suppose, right? So just one payment at the end of the 3 weeks. No collateral. So and he's going to charge her. He doesn't talk about a percent. But for the $400, he's going to charge her $70 interest. So she'll end up paying back $470 at the end of the 3 weeks. Now, that doesn't sound like it's too unreasonable. But let's figure out what the actual APR is. What would the rate be if it was annualized? Okay, compared to some of the other rates we saw. So let's take the interest that he charges, dollar amount, 70, divide that by the $400 she borrowed, okay, and you should get 0.175, okay? You think, oh, 1.75, that's not too bad. But remember, this is a 3-week rate. Okay, that's a 3-week rate. Or 7, well, I said 1.7 would be 17.5. So yeah, it's getting higher, but it gets worse than that. So 17.5 for 3 weeks. Let's get this to an APR. Okay, so we're going to need the daily rate, the daily interest rate, right? And then we can work out the APR, knowing there's 365 days in a year. Book sets it up in kind of a goofy way there. Not goofy, but confusing. So it's a 3-week rate. So there's 21 days in 3 weeks, you'd agree, right? So let's get the daily rate for this loan, like the interest that actually accrues each day. Daily rate. Well, that's our 0.175 divided by 21 days in 3 weeks, right? And so the interest rate each day is 0.008, yeah, 8 and a bunch of 3s. Okay. All right, so like 0.833% per day. And well, now let's annualize that. If that's a daily rate, if we want the annual yearly rate, we just multiply that by 365. So our APR, or the APR he charges, will be this number, 0.008333 times 365 days in a year. Okay, and you end up at 3.0 0.041. Okay, that is not the percent. Remember, that's the decimal. To convert that to a percent, we need to multiply by 100. Okay? You might think that looks like some of the percents we worked with. Not exactly. But as a percent, this is 304.1% annually. 300, it's over 300% interest. So though it's only $70 for her, if you annualize it, it's a rate, an annual rate of 300%. So this guy makes some pretty good money if he's charging everybody 300-something% for their loans. Okay, so I'd be very careful going to one of these payday stores unless it's a dire emergency. Okay, so let's make sure we can do this. All right, go back. First thing we had to do is get the actual 3-week rate. Okay, here. And then we got the daily rate by dividing that by the number of days in 3 weeks. And then we multiplied that by 365, converted it to a decimal. So there's a check that goes with this. Blue, of course, and it's not going to be. Pause the video. The check should be quite a bit like this one. Let's see how we do. So he's wanting Nicole $900. And she has to pay it back in 30 days, okay? And he's charging her not a percent, but a flat $100 interest. We want the APR. So let's do it, set it up the same way. So let's find the month rate. So that would be our $100 in interest divided by the 900 that she's borrowing, which gives us something like 0.11111, right? So she's borrowing it for a month, okay? So we have to get a daily rate. So we take that 0.11111, and we'll divide that by 30. We're assuming a 30-day month, okay? And you get 0.037037. And now we can convert to APR. Since that's daily, we multiply that. So our APR is going to equal this, 0.037037 times 365 days. And that comes up to 1.35. Again, that's not the rate as a percent. We now have to make that a percentage. Move the decimal twice. That's 135%. Crazy. Boy, it better be a dire emergency, I would say, if you have to borrow from someone like that.